How did a world that once bartered cows for grain evolve into one where $7.5 trillion changes hands every single day? And that is just by exchanging currencies? Where did it all begin? Who shaped it? And how did this hidden engine of the global economy come to dominate the financial world, silently influencing the price of everything we buy? Welcome to the untold history of Forex trading, a story that stretches from ancient marketplaces and medieval banks to presidential decisions and artificial intelligence. Let's start at the beginning. Long before dollars, euros, or yen existed, there was barter system. You had goats, I had wheat. We made a deal. Simple, right? But then comes a problem. What if I didn't want your goats? This limitation was called the double coincidence of wants. On a small person-to-person level, a barter system would work, but this made large-scale trade almost impossible. That inefficiency drove ancient civilizations to seek something better. Fast forward 2,000 years and a continent away. It's the 13th century in China, under the Yuan dynasty. By now, the empire is massive and growing fast. But there's a problem. Coins are heavy, slow, and risky to move across long distances. So China did something radical. They introduced paper money. By the time Marco Polo arrived in the 1270s, China already had a well-developed monetary system. They had denominations, legal protections, and serious consequences for anyone who tried to cheat it. While modern bills might say, "In God we trust," Chinese notes had something else printed. Counterfeiters will be beheaded. And you know what? It worked. The system thrived because it proved that money didn't have to be made of gold or silver. It just had to be trusted. And that idea, trust over material, became one of the most important foundations of money, and eventually of the entire Forex system. Back in Europe, coins were still the standard for centuries. Precious metals backed economies, especially as European nations expanded, colonized, and hoarded gold. But even gold has its limits. By the 16th century, banks began issuing paper banknotes, written promises to pay the bearer a certain amount in metal. These weren't government issued yet, but they worked. People accepted the notes as money because they believed they could exchange them for actual gold or silver later. Then, across the Atlantic, something unusual happened. In 1685, French Canada ran out of coins. Soldiers needed to be paid, but the ships from France hadn't arrived. So, the colonial governor improvised. He took literal playing cards, signed them, gave them a value, and used them as temporary currency. And surprisingly, it worked. Merchants accepted them. They circulated through the economy, and they were later exchanged for actual coins once they arrived. That moment, using paper and belief to keep an economy running, proved again that money's true power is not in what it's made of, but in the trust people put in it. But even with coins and paper, a deeper question began to rise. What really makes something money? What gives it value besides shiny metal or printed paper? Around 350 BCE, the Greek philosopher Aristotle stepped in with answers. In his book Politics, he broke it down. For anything to function as money, it had to meet 4 key criteria. It had to be durable enough to survive daily use. It had to be portable, so it could be carried easily. It needed divisibility, so it could be split into smaller units. And it needed stability, value that didn't change wildly. He also defined 3 roles that money must serve: as a medium of exchange, a unit of account, and a store of value. Aristotle didn't invent money. Coins already existed. But he gave us something far more powerful, a framework to understand it. His ideas helped societies move from barter toward a shared belief system around value. the very logic that would one day support foreign exchange markets. Now let's jump to the Renaissance. Europe was buzzing with trade, but merchants faced a huge problem. Moving physical gold across long distances was risky. Pirates at sea, bandits on land. Every journey meant danger. That's where the Medici family changed the game. In 1397, they founded the Medici Bank in Florence. Their genius move? They introduced paper instruments called bills of exchange and letters of credit. Instead of carrying gold from Florence to London, a merchant could deposit money in Florence and receive a paper IOU. That note could be redeemed in London after a certain period. It was portable, secure, and recognized wherever the Medicis had branches. Even better, letters of credit guaranteed payment, but only once the goods arrived. That made trade not just safer, but smarter. And the kicker? Because the church banned interest, this system worked as a spiritual loophole. Currency exchange wasn't usury. It was just business. Through these tools, the Medici family didn't just finance trade. They quietly laid the blueprint for the first international financial system. As global trade picked up in the 1800s, countries faced a new challenge. With so many different currencies in circulation, how could you ensure fairness, consistency, and trust in international transactions? To solve that, nations turned to something they believed was incorruptible and universally accepted: gold. That's when the gold standard entered the picture. In 1819, Britain made it official. The value of their currency was tied to a specific weight of gold. Other major powers followed: the US, France, Japan, Germany. Currencies became stable and predictable because they were all tied to something universal: gold. This predictability fueled a surge in global trade. London became the financial capital of the world. And interestingly, one of the key figures behind Britain's coinage system was none other than Isaac Newton. Yes, the gravity guy. Turns out he also helped formalize economic stability. But the gold standard, solid as it seemed, would face its biggest test soon. By the end of the 19th century, the world economy was running smoothly under the gold standard. Currencies were stable, trade was flourishing, and there was a shared belief that money backed by gold meant security. But then came World War I. As nations shifted from trade to war, the gold standard began to crack. Countries needed to fund armies, weapons, and war efforts fast, and they couldn't wait around for gold shipments. So they started printing money without gold backing. That's when inflation kicked in, hard. In Germany after the war, things spiraled into chaos. A loaf of bread that once cost a few marks started costing millions. People carried wheelbarrows full of cash just to buy groceries. Kids used stacks of banknotes as building blocks. Trust in money, the core of any system, was shattered. After the war, countries tried to return to the gold standard, hoping for stability. But then came the Great Depression and World War II. Again, economies were wrecked. Trade collapsed. Gold reserves were drained. And this time, the gold standard didn't come back. The world needed a new plan, a new anchor. In 1944, even as World War II raged on, the world's top economic minds came together, not on a battlefield, but in a hotel in Bretton Woods, New Hampshire. Representatives from 44 allied nations gathered to design a new global financial system. They had seen what economic collapse could do, and they wanted to build something stronger, something that could survive future crises. Two men took the lead: Britain's John Maynard Keynes and America's Harry Dexter White. Keynes had a vision for a new global currency called the Bancor to make trade fair between rich and poor nations. But White had a simpler and more strategic idea: use the US dollar. At that point, America held most of the world's gold. and had the strongest economy. The world agreed. The new system worked like this. Every country would fix its currency to the US dollar, and the dollar would be tied to gold at $35 an ounce. They also created the International Monetary Fund, IMF, and the World Bank to support struggling economies and rebuild war-torn nations. This system brought stability, and it worked for nearly 30 years. By the late 1960s, the Bretton Woods system was under pressure. The US was spending big on the Vietnam War and new social programs. At the same time, Europe and Japan were recovering fast and selling more to the world. They were earning and holding a ton of US dollars. But under Bretton Woods rules, every dollar was supposed to be backed by gold. And here's the problem. There were now more dollars in circulation than gold in US vaults. In 1971, President Richard Nixon made a dramatic announcement. He suspended the dollar's convertibility to gold. The moment that link was cut, the Bretton Woods system collapsed. Currencies were no longer tied to gold. Instead, their value would now be set by supply and demand, market forces, interest rates, news, and speculation. This was the birth of the modern foreign exchange market, or Forex. At first, Forex was a private club. Only governments, central banks, and huge financial institutions could play. You needed access to the interbank market, connections, and a mountain of capital. But in the 1990s, everything changed. Because of one thing, technology. Banks began creating electronic trading platforms that let them execute trades instantly. Then, those platforms evolved for the general public. By the early 2000s, trading software like MetaTrader 4 exploded in popularity. With just a laptop and an internet connection, anyone could analyze charts, trade currencies, and even automate strategies. Suddenly, Forex wasn't just for Wall Street. It was happening in dorm rooms, coffee shops, and bedrooms around the world. As technology advanced, so did the tools. Smartphones brought Forex into your pocket. Apps let you trade in real time, from anywhere. Automated systems, known as expert advisors, started placing trades based on preset logic. And then came AI. Artificial intelligence could analyze headlines, social sentiment, economic reports, and make lightning-fast decisions. Algorithmic trading became a whole new frontier, fast, logical, and emotion-free. Forex transformed into a living system, driven by news, politics, patterns, and millions of trades made every second of every day. And still the core idea never changed. Buying one currency, selling another, just a lot faster. So why does all this matter? Because the history of Forex is really the history of money, and the history of money is the history of us, how we trade, how we trust, how we build systems to assign value. From bartering animals in ancient villages to AI trading bots in global markets, Forex evolved with humanity. It mirrored our wars, our peace, our beliefs, and our constant need to exchange. Even today, over 7.5 trillion moves through Forex every single day. And behind every chart, every price move, every rate decision is a story that began thousands of years ago, with someone asking, "What's this worth to you?" If you found this journey through the history of Forex interesting, tap that like button and subscribe, because in the next video, we're diving deep into the top trading strategies that still reflect lessons from this history. Drop a comment and tell us, which moment in Forex history surprised you the most? Thanks for watching. And remember, you're not just trading money. You're trading on centuries of belief, built one trade at a time.